The short-termism of Australian investors and their hunt for yield has placed rising pressures on fund managers in an increasingly volatile, low-growth economic climate. Joining me today to talk about the changing dynamics of passive and active are Hyperion Asset Management Managing Director Tim Samway and State Street Global Advisors Head of Portfolio Strategists for Asia Pacific Jonathan Shead. Tim, Jonathan, thank you for joining us. Firstly, Tim, I'd like to begin by asking you, I guess when we look at the evolving landscape of funds management here in Australia, we've seen an increasing number of active managers hugging the index in this low growth environment. Tim, are active managers having to reinvent themselves, or would a longer outlook make it easier for them to remain true to label?
Look, I can only argue the position from our business, and we haven't had to reinvent ourselves because the long-term outlook is what we've taken for the last 20 years. But it does mean, in my mind, that is the way to go. So if you're in that funny active position at the moment where you're actively promoting your active qualities, but you're actually hugging a benchmark, I think the future is looking pretty average for you.
Mm-hmm. And Jonathan?
Yeah, look, I think hugging the index is a tough game at the moment. You can get exposure to the ASX 200 for less than 0.2%. You can get exposure to a global index for 0.3%. Active managers who hug the index, I think, have got some pretty stiff competition at that low-cost end. I think I'd agree with Tim. I wouldn't use the word reinvent, but certainly there's a requirement for active management to continually evolve. And I think the hurdles for active management are getting higher and higher.
And I guess, one of the interesting points of discussion is whether perhaps we're seeing more active managers incorporate a blend of passive and active strategies. Is that a better sort of approach to incorporate this sort of blend in their investment philosophy, or are the two mutually exclusive?
Well, I can understand why a client, an investor, would consider blending the two. That is, they're trying to reduce the MER of their total investment. That makes perfect sense if you're a cost-conscious investor. It's always done, in our view, at the expense of active return. Obviously, that's self-evident. In terms of fund managers doing it, I think they're making a huge mistake. I think you've got to quite clearly position yourself as an active manager or a passive manager, and I think coming somewhere in between, you'll just get lost in the murky grounds.
Yeah, I think we probably step back a little bit from a simple question of do you go active or passive in Australian equities, for example. We tend to think, you need to start with the client's objectives. What is it you're trying to achieve? Having made that decision, you then say, well, what sort of risks do I want to get exposure to? Do I want exposure to equity risk? Do I want exposure to fixed income risk and so on? That question about should I own Australian equities is far more important than should I own them actively or passively. Once you work your way through that process, you then come to, are there opportunities for active management? We actually believe there are. We believe that there are markets where there are inefficiencies. They might be informational, they might be behavioural, they might be transactional, where you can add value. We think the art is trying to decide where you should go passive and where you should go active. I think I'd agree with Tim that within a single equity construct to go passive and active is neither here nor there. But within our multi-asset products, for example, in our investment solutions group, when they build multi-manager, multi-asset class portfolios, there will be some asset classes where they will say, you know what, we're just going to go passive here. Other asset classes, well, they'll say that's an asset class that we think it makes sense to go active. REITs, for example, the Australian REITs industry only has a limited number of names. You might look at the number of names and say, you know what, I'm just going to go passive there. Or in global REITs, it might only be a small part of your allocation. Do I want to spend the time and the effort and the cost doing an active manager search? No, I'll just use a passive ETF to get that exposure. But then you might come to a core equity position and you might say, actually, this is a key part of my portfolio. There are particular exposures I want to get. There are particular characteristics I'm after, and active management may be appropriate.
Now, I guess building on that, one of the interesting developments that we've seen has been the rise of smart beta, as well as the growing proliferation of exchange-traded products like ETFs. Tim, I'd like to begin by asking you, firstly, should active managers be worried?
Of course they should be worried. If they're not delivering their promises to their clients, then they should indeed be worried. And when you look through the survey, there's an awful lot of managers there that are not delivering on their promises to clients over the long term. I mean, I'm only talking about the long term. A year or two is not the measurement here. It's actually over the long term. And I think that's one of the reasons a lot of the strategies like smart beta have started to pick up so dramatically, is because of the failure of a good chunk of the active management industry to actually deliver the returns they promised.
And Jonathan, with State Street, State Street launched the first exchange trade product here in Australia. I'd be keen to hear your thoughts about the implications that both smart beta as well as exchange trade products like ETFs present to active managers as well.
We were talking earlier about passive and active and kind of the dichotomy between the two. I mean, we actually think that the question for investors is now really passive, smart beta or active. So the way we think of it, smart beta gives you exposure to pretty simple, transparent, diversified factors that frankly active managers have been using for a long time. So if you want a portfolio that has got a bias towards securities with lower prices, if you want a portfolio that's got a bias towards stronger balance sheets, higher profitability, or a bias towards high yield, or all those sorts of factors, you don't need to pay active management fees to get that kind of portfolio construction. And that's what a smart beta portfolio will do for you. And in that sense, the bar for active management has gone up. And we think that smart beta plays a crucial role in the scope, the range of products available to investors. Smart beta actually works particularly well in an exchange-traded fund format. I mean, ETFs provide really transparent, liquid, trade when you want, during the day, that kind of really immediate exposure to markets in a very transparent way. And because smart beta strategies are well diversified and transparent, they fit inside that kind of framework. So it's no surprise that products like SYI, the Australian yield product, or WDIV, the global yield product, and there are a range of yield products on the exchange. It's no surprise that they've become readily available. If you want to have a bias towards yield, that's quite easy to do, and you don't need to pay active fees to achieve it. So we think smart beta and ETFs are actually a really good marriage. That's already reflecting the fact that ETFs in traditional passive space, market capitalisation, passive products are already obviously a huge product suite.
Now, building on that, Tim, we recently spoke about, I guess, the increasingly fee-conscious nature of Australian investors. And Tim, do you think that do active managers have the courage of their conviction when it comes to managing expectations, and how can they better communicate that value to investors as well?
Well, look, I think the challenge is to communicate the value proposition up front and then deliver on it. It's as simple as that. And yes, there's a lot of talk about fee pressure in the market, but I think if you set your fees appropriately in the first place and don't try for fees that are ridiculous, I think a fair fee for an active return is a good deal for clients, because that's what some clients will want. They will want higher active returns and they're prepared to pay for it. And I think that's a very fair deal. If I look back over the last 20 years that we've been in operation, we've produced 5% per annum alpha over 20 years. So that's the difference between $100 turning into $600 and $1,300 the fact that the clients have paid some fees along the way, and active fees of about 95 basis points, is a fabulous return on investment for them. But I think the challenge is for those who are not delivering that. And, quite clearly, smart beta strategies and passive is looking pretty attractive to clients who can no longer see the value for money in active management. So I think there's a watershed coming for the active management industry if they can't lift their returns. And of course, the challenge, of course, is there's a lot of players out there all trying to eat each other's lunch. And it's pretty difficult these days to stick to a strategy in the very long term and deliver those long-term results.
And Jonathan, what are your thoughts on, I guess, the challenge that the growingly fee-conscious nature of Australian investors represents?
Look, I'd have to echo Tim's comments that this is about working out what your value proposition is, communicating that clearly, and then delivering on it. And we still think there is a role for active management. The challenge is that you have to have a very clear value proposition. A value proposition that says, yeah, we're just going to buy lower price stocks, well, that just doesn't cut it. I mean, we do run active products in Australian equities and global equities. The value proposition that we went with was really a combination of trying to find that balance between really strong total returns and capital preservation. It's a kind of a really difficult conflict to manage, but we feel our strong value proposition is the ability to manage that tension between companies that have got strong performance prospects but at the same time preserving your capital. But you then have to deliver. I think too, though, there is an onus on the investor, and to be kind of fair to the industry, a lot of managers have done a lot of work trying to really distill into simple, clear terms what their value proposition is. And I think it's up to investors. You need to read that PDS. You need to understand what it is the manager is trying to deliver and over what time frame. Because there's two ways you can be disappointed. One is if the manager doesn't deliver on what they promised. But the second is if the manager did deliver, but you had the wrong expectations. So I think there's a mutual responsibility there for investors to understand what the manager is offering and for the manager to deliver on what they proposed.
I guess one of the other interesting developments that we've seen has been the emergence of actively managed exchange-traded funds. In the last 2 years in particular has seen strong momentum with this space becoming increasingly saturated here in Australia. Tim, what are your thoughts on this trend and what perhaps can we expect to see from the next wave of active ETFs over the next few years?
Well, look, I just look at these as yet another vehicle for delivering access to an investing public, and there's a myriad of them, whether it's LICs and unit trusts or SMAs. It's just another way of getting it to, and in some cases, a new class of investor or a class of investor that hasn't had ready access to managed investment products in the past. So from that, it's applaudable. That's fantastic that it's giving a whole range of investors access to markets and professional management that they haven't had before. Once again, I can really only speak for us there. I'd rather, over the next 10 years, deliver more highly focused active management products. So, for example, we're doing global. We've been doing it for 3 years now with a terrific outcome, and that'll become available to direct investors. Whether that turns into a LIC and an ETF and an EMTF and all of these will be a matter of the investing public and the demand for them, rather than us trying to pick which is the best vehicle to deliver a product.
And Jonathan?
Yeah, I think there are some particular challenges in this space. Firstly, I'd agree with Tim that if the investment proposition or the ability to deliver isn't there, it doesn't matter whether it's an ETF or an unlisted managed fund or what it is. So I think that has to be the first and most important decision. I think the next is communication. One of the strengths of ETFs is also one of their potential dangers, and that is they're really easy to trade. You only need to know the ticker. And when you're dealing with an unlisted managed fund, there's a certain amount of time involved, talking to your advisor, filling out the application form. You can't get the application form without getting the product disclosure statement and so on. And so I think my counsel would be the fact that it's easy to trade doesn't mean you still shouldn't look under the hood to make sure you understand exactly what you're getting. The final bit I would say is that the very first ETFs, STW, tracking the ASX 200, SLF trading, tracking the REITs index and so on, are phenomenally robust products. So the way units are created and redeemed, the way they trade on the markets, the way market makers create prices, the tax efficiencies, there's a whole myriad of things that happen behind the scenes on those kind of products that make them, in my view, some of the most robust products in the world. The further you move away from that, the more careful you need to be. So the potential, for example, for securities to trade at a premium or a discount to what their underlying holdings are worth. The potential for securities not to be completely transparent about what's in them. Those kind of problems, you really need to look at them closely, I think, the further you move away from a traditional ETF structure.
I guess any final comments that either of you would like to make?
Well, one thing that this discussion has provoked is the constant theme of long term. And I think that's really the advice that you could give to any investor or any intermediary who is considering an investment in either passive or active management. Is really it's all about the long term. And I take on board your comments. The danger in some of these products is that they bring a level of short-termism, the ability to trade on a day-to-day basis, in what essentially should be a long-term investment rather than a short-term trade.
Yeah, I'd just comment to say that there's no substitute for understanding what it is you've invested in. And there are circumstances where ETFs, for example, are deliberately used for short-term trading strategies, but you don't want to do that unless you know what you're doing and you have a very clear goal in mind. For most investors, it is about the long term, and there is no substitute for understanding the nature of the investment or the product that you've invested in.
Well, thank you both for your time.
It's a pleasure.